Ladies and gentlemen, good day and welcome to the NOCIL Limited Q4 FY23 earnings conference call. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. S.R. Dev, Managing Director of NOCIL Limited. Thank you, and over to you, sir.
Thank you. Good morning and a very warm welcome to everyone present on the call. Along with me, I have Mr. Anand, our Deputy Managing Director, Mr. P. Srinivasan, our Chief Financial Officer, and SGA, our Investor Relations Advisor. Hope you all have received our investor presentation by now. For those who have not, you can view them on the stock exchanges and company website. Let me start by giving you overall performance of the company. FY23 was impacted by global recessionary trends and inflationary pressures that impacted the manufacturing sector in major economies around the world. At the beginning of FY23, during Q1 FY23, we achieved highest ever quarterly volumes and revenues. However, as the global market began to slow down, the subsequent quarter experienced a decline in growth. The second and third quarter were particularly challenging, marked by a sharp degrowth in the company's performance. Despite these difficulties, there was some recovery in the fourth quarter, although concerns about our ongoing recession persist. On an annual basis, the sales volume experienced a 4% drop compared to the previous year, mainly due to degrowth in international markets. This decline was offset to some extent by price increase of over 7%. Despite the dip in volumes, we achieved a turnover of rupees 1611 crores for the year compared to rupees 1561 crores for the previous year, representing a growth of approximately 3%. As we have mentioned in the past, NOCIL is focusing on environmental compliance and sustainability. In this regard, we are extremely happy to share that NOCIL has been awarded the silver rating by EcoVadis Sustainability. EcoVadis is a methodology to measure the quality of a company's sustainability management system through its policies, action, and results. Further, Bureau Veritas has issued an independent assurance statement with regard to NOCIL's business responsibility and sustainability report. This is all from my side. Now I request our Deputy Managing Director, Mr. Anand, to take over you through the market scenario.
Thank you, Mr. Dev. A very good morning to you all. Talking of our performance in Q4 financial year 23, on a sequential basis, volumes in exports are recovering. Overall volumes have started showing an uptick. The revenues for Q4 financial year 23 have shown a 21% growth sequentially. We are positive that for financial year 24, we shall continue our efforts to increase our market share. Now let me talk to you about the full year financial year 23. Starting with the domestic market, in financial year 23, we achieved a net domestic revenue of 1,120 crores, indicating a growth of approximately 13%. In terms of volumes, our domestic business surpassed domestic rubber consumption, exhibiting a growth rate of over 6%. This positive performance can be attributed to favorable customer interactions that supported our growth. While talking about exports, in financial year 23, our exports experienced a decline in volumes of about roughly 21%. This decline was primarily influenced by the global economic slowdown, particularly in Europe, as well as a significant decrease in latex production within the Southeast Asian market. On the revenue front, our turnover for the year amounted to rupees 491 crores, representing a decrease of 13% compared to the year's figure of 567 crores. The strengths and capabilities of your company are consistently valued by our global customers. With available capacities and the attainment of necessary approvals, we are poised to capitalize on growth opportunities and work towards long-term vision of doubling our market share in the global arena. Despite the short-term challenges, the China Plus One strategy continues to be an important differentiator for NOCIL, where our customers look for security of supply chain from a long-term and medium-term perspective. That is it from my side for now. I will hand over to Mr. Srinivasan to give you an update on the financial performance.
Thank you, Mr. Dev, Mr. Anand, and good morning to everyone on the call. Now let us take you through the consolidated financial highlights. Sales volume for Q4 FY sequential quarter basis, the volume registered a growth of 26%. As mentioned earlier, the overall volumes are showing signs of improvements. On the revenue front, the net revenue from operations for Q4 FY23 stood at 393 crores from as against 326 crores in Q3 FY23, a growth of 21%. Net revenue from operations for the year FY23 on a consolidated basis stood at 1617 crores as against 1571 crores recorded in FY22. Coming to the operating EBITDA parameters, the operating EBITDA parameters for Q4 FY23 stood at 50 crores consolidated basis as against 38 crores recorded in Q3 FY23. Operating EBITDA for the financial year FY23 stood at 253 crores as against 286 crores in FY22. EBITDA margin for Q4 FY23 stood at 12.7% as compared to 11.6% in the previous quarter or the sequential quarter basis. Coming to profit before tax, PBT parameters, the PBT parameters for Q4 FY23 on a consolidated basis stood at 39 crores as compared to 25 crores in Q3 FY23. PBT for financial year 23 stood at 202 crores as compared to 241 crores in FY22. Profit after tax parameters, the profit after tax for Q4 FY23 stood at 28 crores as compared to 19 crores in Q3 FY23. Profit after tax for the financial year 23 stood at 149 crores as against 176 crores recorded in FY22. With this, we would like to open the floor for question and answers.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Our first question comes from Nirav Jimoria with Annual Research. Please go ahead.
Yeah, good morning, team. So I have 2 questions to ask. So, sir, if we exclude the latex market, which has shown a degrowth in the export side, if you can explain our total coverage of customers globally, which we have identified, and out of those coverage of customers which we have identified, how much we feel still needs to be covered, which at some point of time could be our potential customers. So let's say if there is a coverage of customers which we feel that it is rated on a scale of 100, how much we feel that we have covered and which are still yet to be covered?
Yeah, thank you, Nirav, for the question. So I think if you look at the exports, and as you also kind of pointed out, the volume increase has largely come from even the non-latex part of the business with international tire customers. And when we look at this, it's an ongoing process. I think clearly we are making progress with regard to quite a few approvals that have, like we discussed even in the last couple of calls about the work that's been done on that front. And we see there is good traction. And we are progressing well on this. I would say we are on a good way. Quite difficult to put a finger on a scale of 1 to 10 or 1 to 100, but definitely on the higher side. I would kind of at least give you a certain guidance on that.
Correct. So, is it safe to assume that to the customers to whom we have been targeting in the export side, most of our samples have been approved and probably we are now waiting for the final approvals in terms of volumes to come from them? Or we still need to go to them in terms of further rounds of approvals or anything left to be done to tap those customers?
So these are all in different stages of progress. So I think even from one quarter to the other, month to month, it's a dynamic situation. So quite a few of the customers are approved for the different sites. Some of them are in progress under testing. Some of them have gone into commercial lots. So that's continuously an ongoing process. So I think this will continue to happen as we keep wanting to expand to different sites.
Got it. So just to add, sir, like if you can add, like, or if you can explain that in terms of the newer customers on the export side, have we added anything on last 2 years, and have they contributed anything to the volumes on the export side over last 2 years? If you can just quantify some percentages in terms of the contribution from the newer customers, what we have tapped in the export market and their contribution to the volumes over last 2 years, that would be helpful.
Yeah, so I think clearly there is contribution coming in from, while all the customers globally, the tire players internationally have been our customers for one product or the other. In the last few months, for sure, there has been expansion of the product portfolio with each of them. It would be difficult to put a specific number here of exactly what percentage. I would not at this point in time be able to comment. Yeah.
Okay, but those volumes to whom we have added the customers have been steadily moving up.
Yes, absolutely.
Got it. So second question is in terms of our gross margin. So if we see FY23 over FY22, there is an improvement on a per kg basis. But when we see our Q4 numbers, I think that is being showing signs of falling. Probably maybe the raw material prices have not fallen in tandem with the fall in the realizations. So if you can share your thoughts about how we should look our gross margins for FY24. And let's say on the volume side, if we take a base of Q4 of FY23 and multiply it by 4, we'll be still having some 10% volume growth over FY23. So if you can share your thoughts on both these things, that would be helpful. Thank you.
Srinivas here. To answer your question very differently, we would like to say, I think we have been communicating to the investors at large that we are not looking at gross margins as a percentage to be looked at this business. What we are more concerned is how do we protect our EBITDA margins per kg, and that is what our focus is. At the same time, we cannot disregard the fact that we have to capture more market share. So it's a dynamic situation, and you need to adjust the prices according to the market situation. So it's a combination of a wallet share increase, additional volumes, and some bit of price corrections or price adjustments, and also EBITDA mark per kg, trying to maintain a track of EBITDA per kg is what we are looking for. So we don't look at value addition as a percentage to the revenue. We have, because in a high cost regime, you cannot continue to look at that 45% or 50% thereabout. We should be looking at EBITDA.
From per kg basis only. So I was also comparing on a per kg basis in FY23 versus FY22, and even for Q4 of FY23, I was looking on a per kg only. So because percentage becomes a misnomer in a rising as well as a falling pricing scenario. So just to put the things differently, sir, even if you can explain, like.
Okay, to answer it very differently, see, when you lose volumes, your operating leverage benefit doesn't come in. So when you are to look at a volume growth, then the operating leverage benefits comes in. And that is what you are seeing in this quarter, if you see the benefit of the absolute profit numbers. So we look at a particular utilization level to which the operation is to continue, and therefore we target for volumes and thereby improve our EBITDA margins.
Correct. And sir, on the volume side, I think if we just multiply it by 4, the Q4 volumes, I think it is giving us some 10% volume growth over FY23. So is this the right number to work with, or are we seeing further improvement in the volumes probably in H2, where like in the initial remarks Mr. Anand mentioned about tapping those customers and improving the wallet share from them. So when can we see a meaningful improvement in the volumes over Q4 numbers? If you can just share your thoughts here. Thank you.
While I kind of I think at this point, if I look ahead into the year, we are quite positive the volumes will improve from the current position. Yeah. Yes, it's an add-on to what I said earlier that the efforts with customers begin to more trickle in as we go along.
But that should be over Q4 volumes you are talking about, right, sir?
Yes.
Okay. Thank you, sir, and I'll join back in the queue if further questions.
Thank you.
Thank you. Our next question comes from the line of Aditya Ketan with SMIFS Institutional. Please go ahead.
Yes, sir. Thank you for the opportunity. So my first question was onto the export market. So this quarter we had witnessed a significant revival in volumes in exports market. So particularly if you can highlight apart from Europe, which are the other geographies which have witnessed expansion in volumes?
Yeah. So while we just mentioned also in the opening address, the clouds of the recession and the sentiment continue to remain cautious. The expansion in volumes have happened partially in Europe and in Asia also, both.
And so this situation will continue to improve, or you see now this, so the benefit has been played out and it can be flattish for the coming year?
No, we see that we can grow from here. Yeah.
Okay. And so just a question onto the imports of rubber accelerator from China. So recently, only for the last 2 to 3 months, we had witnessed some sort of increased imports from China market into India. Is this one of the reasons why the realizations are under pressure? And how you see, also considering if the competitiveness will start to increase, so how difficult or easy for you to maintain the per kilo margins in the near term?
Yeah, I think the per kg margin was also alluded to by Mr. Srinivasan a little while earlier. But the point that you made earlier was also to the fact that with the Chinese market economy per se not having such a high offtake, Chinese imports into other countries are increasing, and there is a lot more aggression on pricing that we see, which we also mentioned earlier that in case the Chinese economy doesn't pick up, we see that 80% of rubber chemical capacity, you would expect more volumes trickling into the international market. So we do see that scenario playing out.
So that can impact the per kilo margin, sir, in the near term, or we can maintain from here on, or how you see the trend to shape up?
So I think from that point, we're looking at the overall margins that we can retain and look to see how we can keep the volumes growing while adjusting our prices to the market dynamics. Yeah.
Okay. So just one last question, sir. In this quarter, we had witnessed an employee cost decline on quarter basis. So particularly, sir, this quarter there are increments and bonuses which are given to employees. So generally, the employee cost should be high, but we had witnessed a decline. So is there any specific one-off in employee and other expenses also, which has led to your expansion in EBITDA margin?
I think to answer your question, employee cost is it's an annual number. We make a quarterly provisions as per the terms of the employee and remuneration cost, etc. So there could be slight change here and then. Components is not material, if you ask me.
Any
Still at 21 crores, per se.
Got it. So generally, sir, so what I was asking, sir, so generally this quarter employee costs tend to be so relatively higher because of increments given and because of bonuses. So that is what
Just to answer your question, when we make a provision on the employee cost, we look at the overall components of the cost, including the variable, and we make pro rata provisions on a pro forma basis, subject to final approvals and the final decisions.
Got it. And sir, also
we set this bonus part or the variable part evenly throughout the year.
got it. And also, sir, in other expenses, is there any one-off which you have taken?
I think there is nothing. There is some effort on other expenses consist of utilities. So there is a lot of effort which is being done on utilities to control that.
Got it. Thank you, sir. That's all.
Thank you. Our next question comes from Rohit Nagraj with Centrum Broking. Please go ahead.
Yeah, thanks for the opportunity and congrats on good Q4. So first question is in terms of the market. So with limited understanding, what I gauge is that in South Asian market, the global players are trying to increase the tire manufacturing capacity. So just wanted your perspective in terms of whether we are currently supplying to them and whether this could also be an opportunity from an exports perspective. Thank you.
Yeah, thanks, Rohit. Yes, there is expansion happening, and we are working with all these customers. So the opportunity continues. Did I answer your question, Rohit, or you need a bit more elaboration?
I just wanted to get a perspective. So currently, these customers are being serviced by Chinese players, and we will have to make inroads. And will that effort have some kind of a gestation period?
Yeah. So as I mentioned earlier, so yes, so it's being supplied by a mix of Chinese and European and even Asian players. So we are working with these customers, and these approvals are site to site. So you don't have a central approval, but you work from a site to site basis. You need to get the products approved, and there is a reasonably good traction on that front.
Right. Got that. The second question is recently China Sunshine also came up with their update. And they had particularly, again, the volumes have been good, but the average selling prices have come down. So has those selling prices now got stabilized, or they are still coming down in the wake of lower Chinese demand and probably influx of the volumes? Thank you.
Yeah, so we are still seeing marginal reductions in prices, which continue to happen in the market. Wherever I think we see lack of demand in the domestic market, they seem to be wanting to take opportunities outside. So we do see that pricing behavior to continue here in the last few weeks. Yeah.
Sure. Thanks a lot, and best of luck. I'll come back in the queue for further questions.
Thank you. Our next question comes from the line of Jainam Gilani with Swan Investments. Please go ahead.
Hi, sir. Thanks a lot for giving me this opportunity. So, what is the capex guidance for the next 2 years? That is FY24 and FY25?
Capex? Sorry, we're just checking on this. So, yeah, so it's largely maintenance capex, and debottlenecking that we planned is also included in that.
Okay, so we are not planning to increase any capacities as of now, like only through debottlenecking?
Yes, that's right.
Thank you, sir. And would this, like, what can be the sustainable margins going forward, sir? If you could give us some rough guidance.
Margins per kg?
Yes.
We cannot give any specific guidance on that because it all depends on the market situation. While we aim to maintain these numbers or we would like to improve, but it all depends on how the market unfolds.
Okay, sir. Thank you.
Thank you. Our next question comes from Nitesh Dhoot with Prabhudas Lilladher. Please go ahead.
Hi, sir. Thank you for this opportunity. So my first question is on the gross margins again. I just wanted to check, the gross margin impact was also a result, of some higher cost inventory that was carried over from Q3. Because as I recollect during our last interaction, you mentioned 65%, around 65% capacity utilization, while the volumes, suggest a somewhat larger number. So if you could just help understand.
To answer your question very differently, while we understand that the operating rates of the plant operations during the year was on the lower side because of the degrowth, our endeavor has been to maintain the capture volumes and maintain the absolute EBITDA per kg is what we are aiming for. In this process, there could be some change in cost margins, etc. So we will get back to you on the exact details separately.
Sure. So, sir, just to continue on this, is the spread, also a function of the product mix, whereby we would have sold more of antioxidants versus accelerators, and as I understand, antioxidants would possibly carry, slightly lower spreads there. Would that be a fair understanding?
I think this quarter we have seen a stock change debit, so which means we have sold something from the inventory. That's what it is. Your question is on that. Whether that cost is from the previous legacy cost or was higher or this quarter is on the lower side, that's what you're looking for. It was not such a major big change in that sense. I think largely this quarter performance improved on account of volume and very marginal impact of cost.
Sure. Okay. So also on accelerator sales volumes, how they actually behaved in FY23, and just to continue from one of the previous participants' questions, that are we seeing any kind of demand challenges over there over the last few quarters, or is it like are the sales normal? Because we've seen lower accelerator volumes from other players also. So just if you could help clarify this.
So Nitesh, usually, so they go in tandem, right? So your volumes of antioxidants and accelerators, they go in tandem, and typically antioxidant consumption is larger than the accelerator consumption. So from a demand perspective, the answer would be equivalent for both the product groups. And if you look at that from a domestic market, we still see the demand to be quite robust with clear plans by our customers to continue to grow. And international markets, while there is quite a lot of apprehension about how the recession eventually pans out, but I think the demand in the world are quite different. So again, you see a lot more apprehension in Europe compared to the US or Asia. And Asia seems to be a slightly bit more, if not same to positive in terms of outlook into this year. So demand side seems to be more flattish in the international markets and more robust in the domestic markets.
Right, sir. So my next question is on the working capital. So we've seen improvement on the working capital side there. We did, I think by reduction in inventory days and also receivable days. Do we see a further improvement on this front, or are we back to optimal working capital intensity?
Working capital is it's not a yearly number which you should be looking at. You should look on a quarterly basis, and it's more to do with the quarterly performance, how the level of activity and the performance of the various parameters like sales and the raw material costs, etc. So it's linked to that. That's number one. Number two, while we have been making a conscious effort to indigenize our local supply chain procurement, this will reduce your lead time on inventories is what we are aiming for. Debtors are receivables are generally related to the quarterly sales. Now it is related to the quarterly sales movement. So, and payables depends on the payment terms offered by the suppliers, whether it's a cash, it's a credit terms or a less credit terms depending on the price advantage or the discount advantage. So that we will reach a dynamic situation. So from a working capital perspective, during the year there was a degrowth, and that happened. That helped us to recover in short something like 75 crores infusion cash into the PT. But going forward, yes, it depends on if the supply chain continues to be local procurement, then we will see not much significant level of activity deployment in working capital. If the volume grows up, then definitely some additional working capital deployment will be required.
Okay, that's very helpful, sir. Thank you so much. I'll join back in the queue if I have more questions. Thank you so much.
Thank you. Our next question comes from Damodaran with Acuitas Capital. Please go ahead.
Yeah, thank you for the opportunity. So a few questions from my side. The first one is, China Sunshine had recently released its AGM minutes. So when they called out that demand remains weak globally and supply exceeds demand, and they have embarked on a strategy of increasing sales volume. So in this backdrop, how does this pose as a challenge for NOCIL to gain market share in the exports market? I mean, do you have to give higher discounts or adopt a more aggressive price strategy? And what are the impediments on that front? If you could highlight, that would be useful. That's one. And another question is on the domestic market. We have seen most of the major tire manufacturers in India announced CapEx plans. So what sort of visibility does it give for the domestic growth over the 3 to 5 years? If you can sort of give us a number, that would be great. Yeah, those were the 2 questions from my side.
Yeah, thank you, Mr. Damodaran. So on the international market, yes, I think all of us know that the Chinese pricing can swing from one side to the other, and there is that risk. But our focus is on working at a strategic level with customers on a more medium to long-term basis and not look at it from a transactional basis. So I see that that tends to be more sustainable rather than look at prices going up or down. And we know that Chinese players can play it that way. So that's our approach, and we are quite positive that should work with the international customers, and that's the supply reliability and confidence that we have built with them in the last few years. Coming to the domestic market, I think there is sufficient robustness in the market. So if you look at tire companies, they have quite strong plans looking ahead, and they've also announced growth plans going into the next years, and also projected to grow at about at least 10% on an annual basis for the next few years. So we see that that demand will also grow with that, and we can work closely with our customers to continue to improve our business. The other sectors also, when we talk about the non-tire part of the business, be it related to the auto segment or the industrial segment, they continue to grow at plus or minus 1%, close to the GDP rate. So I think that still looks positive as we look ahead.
Sure. And given that there is, we are confident about exports as well as domestic doing well for you, and with the overall capacity utilization remains at around 68 to 70% is what I'm assuming. How would you still look at CapEx announcement plans? Well, you got it that no CapEx for the next 2 years, but if our plans pan out, we should be running out of capacity in the next 2 to 3 years. If that a fair?
No, not really, because we do see there are opportunities for debottlenecking in a different plants. And in case we have mentioned this also in the earlier call that we will take early action in case we see the need for additional big-time investments.
Yeah, and so what will be the quantum of capacity that you can add by debottlenecking? If you can give a percentage. Or?
Yeah, it's about 10%. Yeah, 5-10%. Yeah.
Okay.
Sure. Which products, from product to product it varies.
Sure. Thanks. That's all from me.
Thank you. Our next question comes from Swarnashish Chatterjee with Asterisk. Please go ahead.
Hi, sir. Thank you for the opportunity. Am I audible?
Hello.
Hi. My first question is, could you please share what is our market share in US market?
In the US market, is it?
Yeah. And is there any Chinese import duty still going on?
Yeah.
Yes.
Yes, there is still the Chinese import duty into the US. Our market shares in the US would be quite low, I think. Yeah, it's the low single digits. Yeah,
the low single digit. However, from a base level of 2019, I think we have already grown up by 3 times.
Yeah.
From 100 level, index of 100, it has come to 300.
I think your volume used to be 1,000 metric ton, and now you have moved to 3,000 metric ton, and the market would be around 1 lakh metric ton.
No. I think, I'm sorry. On index level, we were at 100 in 2019. Today, we are at 300. We are not talking about specific volume numbers.
Okay. But in 2019, volume share to around 1,000 metric ton. That's what I'm saying. But I'm saying why do we see this volume in probably next 5 years? Would the China import duty benefit us?
Yeah, so there are opportunities in the US market, and like what Mr. Srinivasan said, we have been able to increase the volumes, and there are more approvals also continuing in the US market, and we see that they will also slowly start increasing in the next few years.
And do you see our full capacity utilization by FY25?
Full capacity utilization by FY25. I think we did initially give a certain timeline, but I would say yes, yeah. I would say we kind of then also, given the uncertain environment, I think we will take it as we go along. Yeah. So.
Okay. Thank you.
Thank you. Our next question comes from Anubhav Sahu with Macpro Research. Please go ahead.
Hello.
Yes, Mr. Sahu, please.
Yeah. So I had this question about the opportunity we are seeing in Europe. Is it more about getting new customers, or it's an extension of portfolio of existing global customers? And if you could also talk about how much Europe now contributes to our exports, please.
So if you look at most of our customers, we are already present. So it's more expanding our portfolio presence with these customers, and that would mean entail approvals and things like this. So basically, bottom lining the answer, we are present with most of the customers. It is an expansion within the customers. In the non-tire parts in Europe, we probably would be touching newer customers. If you look at the share of our total in Europe, out of our total exports, roughly about 20% to 25% would be our total share from Europe.
Okay. And just a clarification regarding debottlenecking, I think, did you mention that it will contribute to about 5 to 10% capacity expansion?
That's right.
That's right. Good. And so what would be the capacity utilization right now, given how the volumes were in Q4?
For the year, we recorded 62%. I think for the quarter, we may be about 66, 68%.
Okay, that's helpful. Thanks a lot. Yeah.
Thank you. Our next question comes from Shivani with Axis Securities. Please go ahead.
Hello. Am I audible?
Yes.
Oh, hello, sir. Thank you for the opportunity. I am new to the company. Can you please tell me the current product-wise capacity for key different products and the current capacity utilization level?
Ma'am, we don't give any product-wise capacity breakup. However, we can just now with the previous question we answered that for the financial year 23, our capacity utilization was 62%. For the recent quarter of Q4 23, we are utilization of 66-68%.
Okay, thank you.
Thank you. Our next question comes from Aditya Ketan with MIFS Institutional. Please go ahead.
Thank you for the follow-up. So the debottlenecking exercise of 5-10%, this will be completed in FY24 or FY25?
24. Largely FY24. Maybe some other option comes, we will even explore that.
In FY24. And sir, what would be the rough capex which we have highlighted?
It's very marginal. It's not major amount.
Okay. And sir, just more, sir, one more follow-up, sir. Earlier we had stated onto the guidance, onto the newer capacity which we had expanded 2 years back, we had stated that by March 24 we would be reaching peak utilization level. So any sort of guide to change into the guidance or what are you thinking?
So I tried to address that a little while earlier. So I think given the environment, I would not want to put a specific timeline to this, Mr. Ketan.
Okay. Thank you.
Thank you.
Thank you. Our next question comes from Rohit Nagaraj with Centrum Broking. Please go ahead.
Thanks for the follow-up. Sorry. So first question is on the inventory destocking happening in domestic and global market. Is the inventory destocking completed and now the normalized volumes are happening?
Yeah, we did see inventory destocking. I would say it has stabilized to a certain extent, but there is still there's a lot of cautiousness in the purchase. I would still say that.
Rohit, there's too much of disturbance in your line.
Is it better?
Were you able to hear us, Rohit?
Yeah. Is this better?
Yes, Rohit.
Yeah. So in terms of the raw material prices, so have they also more or less stabilized? And in terms of the operating environment too, from the fuel cost, power cost, more or less now there is no significant fluctuation?
Rohit, I think you are aware of what's happening in the crude market. I think the crude price continue to fluctuate, and most of our major raw materials are the precursors from crude. So there is always two type of things. One is the crude oil prices, it starts affecting the prices, and the second is the demand supply position. Okay. So it's a pretty complex situation. I think sometimes we see that the prices are going down. Sometimes we see that petrochemical starts operating at a lower operating rate, which takes the prices up.
Right. Just a couple of bookkeeping questions to Srini sir. What is the cash at the end of the year, and what was the exports revenue during the year? Thank you.
Exports revenue was 491 crores. I think Anand briefed at the start of the call. Cash at the end of the year may be around 200 crores.
Okay, sure. Thanks a lot. Thank you so much, sir.
Thank you. Ladies and gentlemen, if you wish to ask a question, please press star, then 1. Our next question comes from the line of Nirav Jimudia with Anvil Research. Please go ahead.
Yes, sir. Thanks for the opportunity again. So, two questions here. So, one on the latex side. So, I think this is predominantly our specialty portfolio, and this has seen a degrowth in FY23. So, if you can share what was the utilization level in FY23 and FY22 for the latex portfolio of products?
I think, Nirav, to address the question very differently, you should look at the rubber consumption in the Southeast Asian market consumption parameters. That probably will answer most of your queries. And it should be, I think it is about minus 30% degrowth in rubber consumption in that market. So we essentially have to follow the same trend, and in a market which is as depressed, so our degrowth will be slightly higher than that.
Sir, second question is on the cash level what we have. So I think you mentioned that we have some 200 crores of cash in our balance sheet. So are there any opportunities in the near term where some of the products probably where we are not present, some of which are imported in India, and where we feel that now our R&D has done some sort of breakthroughs in terms of replacing those imported products, and we can plan an immediate capacities over there? Or on the exports, have we developed some products where earlier we were not there, and we can now had a breakthrough and we can set up those capacities, not with sort of higher capexes, but with the minimal level of capexes, we can set up those capacities and get those breakthroughs?
Yeah, so Nirav, there are two ways we look at this, and as you pointed out, one is the indigenization part, and that's something that we are working with our customers to see where the opportunities are in terms of local production. Our first option would be to see how if we can swing our existing capacities to produce some of these products. Where there are some opportunities to do that, we are doing it wherever it's possible. And in terms of other products which you touched, which is about newer products, and that is something we are working with, not only domestic but also international ones. And there is work in the pipeline, and these things take some time. But we are positive something will come out, in the near future.
Got it, sir. And sir, in terms of the process part, if we compare ourselves with the competitors for some of the products, or let's say the bunch of the products what we have, do we feel that we still need to improve on the process side for any of these products, where it will ultimately help us to improve our margin? So do you feel that some work has to be done on that part also, apart from the newer products which we eventually plan to introduce?
Nirav, actually to address the question, you have to compare the performance of, say, some of our competitors, and especially Chinese competitors. Yeah. When we look at the Chinese, do some favorable export incentives or tax rebates, they incorporate in their financials and the profitability. In our case, we don't have that much luxury or that flexibility. So despite that, if our performance on a per kg basis or on an overall basis is almost better than some of our Chinese competitors, it gives us the belief that technologically we are slightly superior than their perspective. To that extent, it gives us confidence. At the same time, this is what we have achieved, our endeavor to improve our technologies will continue.
Got it. So, last question from my side would be, at what level of capacity utilization we feel that real benefit of operating leverage would start kicking in? We are at 62%, 67% for Q4. So let's say at what level of utilization we feel that the real benefit of operating leverage would start kicking in, and at that point of time we can think of an fresh round of capexes. Thank you.
So, Nirav, I think this is, if you really look at it, it's a linear equation. As we keep on increasing the volume, we will continue to get the benefit of operating leverages. So it's not a break point, it's a continuous process. So that's what I think exactly we have been saying, that our endeavor is to keep on increasing the volumes so that we continue to get the operating benefits.
Yeah. Thank you, sir, and I'll join back in the queue.
Thank you, Nirav.
Thank you. As there are no further participants in the queue, I now hand over the conference to Mr. S.R. Dev for closing comments.
Thank you. I take this opportunity to thank everyone for joining the call. I hope we have been able to address all your queries. For any further information, kindly get in touch with me or Strategic Growth Advisor, our Investor Relation Advisor. Thank you once again.
Thank you. On behalf of NOCIL Limited, that concludes this conference. Thank you for joining us. You may now disconnect your line.